Hello everyone, I hope you're doing well. In this part we will talk about the long-term sources of finance. We've got different sources of long-term finance. We've got the bank loan, hire purchase, leasing, mortgage, debenture, and share issue. In this part we will talk about each point of them with its benefits and the limitation in addition to the explanation of each one. Remember that the word leasing is another word for renting. Long-term sources of finance. Any source of finance which is required for more than 1 year is classified as long-term. Some of these sources may be needed for buying non-current assets with a relatively low value, for example, a motor vehicle. So the amount needed will be quite small compared to the finance needed for another type of asset, which is the non-current asset. Example, like a new production line or a factory extension. So we've got different needs. So first source of long-term finance is the bank loan. The bank loan is the most common source of external sources, of course, of finance. The amount borrowed is offered with either a fixed or variable rate of interest. It depends on the agreement you sign with the bank. If the rate is fixed, then the business can be certain as how too much interest it will have to pay over the whole life of the loan. And of course, this is good because it reduces the risk to the business of increased costs in case of variable, if interests on borrowing rise in the future. The variable rate of interest can rise or fall depending on the economic factors. Small businesses often find it difficult, of course, small businesses like a sole trader and partners find it difficult to obtain bank loans as they are seen as a greater risk by the banks. If they are able to obtain a loan, even in this case, this is often at a higher rate of interest. They will not receive it at a low one. No, because they are small businesses. Then might be charged to larger businesses. This is on the other hand, because larger businesses are considered to be much lower risk. Also, large businesses will often have collateral or security. Collateral is another word for security against any money borrowed. So they are not considered a high risk as small businesses. What are the benefits? These are usually quick to arrange. They can be varying for varying lengths of time. It depends on the agreements. Large companies are often offered low rates of interest, of course, as we said, unlike small businesses. The limitations is that the bank loan will have to be repaid after all, in addition to the interest. So we have two types of costs: the money or the amount borrowed in addition to the interest rate. Security or collateral is usually required. And this means that the bank may insist that it has the right to sell some of the firm's property if it fails to pay the interest or doesn't repay the loan. A sole trader may have to put his or her own house up as a security on a bank loan. That's why we say that it has unlimited liability and it can risk losing its or their own personal wealth. This is the definition of the bank loan. It's the provision of finance by a bank which the business will repay with interest over an agreed period of time. Second type of long-term finance is leasing. As we said earlier, leasing is another word for renting. Leasing is most often used as a source of finance when we rent what? Non-current assets or fixed assets. Okay. In return for having use of the asset, the business pays the leasing company a fixed amount over a set period of time. This payment is paid monthly or quarterly as you agree together. The asset is not owned by the business by any means, and at the end of the lease term, it can give the asset back to the leasing company. You are just renting it. You will use it for a specific time, and then at the end, it's not yours, it's the leasing company's. The leasing company is usually responsible for the maintenance and the repair of the asset, not the business. Why? Because the business doesn't own it. The benefits? The firm doesn't have to find a large cash sum to purchase the asset to start with, because they are not buying the asset, they are just renting, so they will pay a small amount of money, which is the rent every month or quarterly as they agree, but they will not pay the full amount of money because they will not buy it. The care and the maintenance of the asset are carried out by the leasing company. The limitations? Of course, after all, the total cost of the leasing charges will be higher than the purchasing the asset itself. You will find this on the long run. After you sum up together all the amount you paid for the rent, at the end you will find that you have paid a lot, even more than the real price of the asset. But you will not feel that because you will pay it, as we said, monthly or so, on small amounts. So leasing or renting, obtaining the use of a non-current asset by paying a fixed amount per time period for a fixed period of time. Ownership remains with the leasing company. You're not the owner. Third way is hire purchase. Hire purchase is like buying something with installments. That's it. Hire purchase. Like leasing, hire purchase is most often used again for the non-current assets like machines. However, the difference is that the business doesn't own the asset from the beginning, and it does own the asset from the beginning, and it's responsible for any maintenance, because at the end you will have this asset. It's yours after all, but the point is you are buying it with installments. Both leasing and hire purchase enable the business to have the use of an asset without the need for a large one-off cash investment. You don't need immediate cash to pay. The cost is spread over time, usually 1 to 5, because this is a long-term finance, and this can be financed out of the working capital. Both of these sources of finance include an interest charge as part of the payment, of course, and the main limitation with both of these sources of finance is that they are expensive, as the interest charges are much higher than other finance options. So let's put it in points, the benefits and limitations. The firm doesn't have to find large cash sum to purchase the asset at the beginning. The limitations: the cash deposit is paid at the start of the period, and interest payments can be quite high. The fourth source of finance is mortgage. Mortgage is similar to a bank loan, but it's used specifically for the purchase of land or buildings. This picture might help you to understand and remember. This is the definition. The advantages of doing so is that the land or the building will be the business's at the beginning. From the beginning, it is yours. The limitations: interest is charged on the amount borrowed. It's still a loan, and this must be paid each year. By the end of the mortgage term, the amount borrowed must be completely repaid. So it's both the amount of money borrowed and the interest, since we are talking about a kind of loan. Fifth source is the debenture. Debenture is a type of bond that a business sells in order to raise very large sums of money, and in return for buying the bond or debenture, the buyer receives a fixed rate of interest per year. This is the definition of debenture and the definition of the word bond, just in case you didn't know it. At the end of the debenture term, the full purchase price of the debenture must be repaid to the debenture holder. This is very important. It's usual for the business to provide the security against the value of the debenture, so that the debenture holder is guaranteed to get their money back. There should be a type of security, because it's like the debenture is like an investor who is investing their money or lending the business their money. So there should be something in return, which is the security, to be guaranteed that they will get their money back, even if the business is unable to repay it themselves. For example, we have a business that may provide the debenture holder with the legal right to sell some of its land or buildings. This is a type of security if it fails to repay the amount borrowed after all. The benefits: the business is able to raise large amount of capital, of course, and the limitations is that the full purchase price of the debenture must be repaid to the debenture holder. The business has to provide security and collateral. Number 6, the share issue. This is the last source of the long-term finance. This source of finance is only available to whom? To limited companies, because they are the ones with the legal structure that allows them to raise finances through share issuing. Of course, as we know, the sole trader and the partners cannot do so. The company can offer their shares up to a maximum number, and it's called authorized share capital. Private limited companies, as the term suggests, the word private, they can sell the shares to private investors like family and friends, but the public companies can sell the shares to the general public. The amount of capital raised through the share issue becomes permanent capital to the business and never has to be repaid back, because it's not borrowing. You are not borrowing and you will pay that back. No. Okay, unless the business ceases to trade, like stops to trade, or they will end or close down. This is the definition of share issue. It's a source of permanent capital available to limited liability companies. The benefits of doing so: it's a permanent source, as we said, which wouldn't have to be repaid to the shareholders. And as we said, it's not borrowing, so there is no interest to be paid. The limitations: dividends are paid after tax. whereas interest on loans is paid before tax is deducted. Okay, so the dividends might be at this stage very low, and there is dividends that will be expected by the shareholders. This means that you will have to pay them the dividends in case you are profitable, of course. And of course, the ownership of the company could change hands if many shares are sold, like more than 50%. So, after knowing all these sources of finance, so the question is, debt or equity is the best source of finance? So, we've got debt financing, like borrowing. You borrow and there's a debt, or equity like things that you own using your own, maybe machine, land, or so. Of course, as usual, we have benefits and limitations for both. So if we start with debt financing, like borrowing, it doesn't change the ownership of the company. You're just borrowing some money somewhere, and you have to pay it back after a while with some interest, and you are done. But it has nothing to do with the ownership of the company. You're not selling parts of your control or your ownership. And lenders have no say in the running of the business. It's only their money, and they need their money back, and that's it. The limitations of debt financing, like borrowing, of course, there is interest that is charged on the amount borrowed, and this increases the business costs. Of course, interest must be paid even if the business makes a loss. The amount borrowed must be repaid. Again, we have two types of cost: the amount borrowed itself and the interest. So these are the benefits and limitations for the debt financing. For the equity financing, it has never to be repaid, because you are not borrowing from anyone, so you'll have to repay. No, you're not borrowing. It's your own capital. There is no ongoing cost like interest or so. If the business makes a loss, it doesn't have to pay dividends to the shareholders, because in this case, shareholders are considered owners, and they will bear this burden with you, which is you're not making profit, so they will not ask for dividends, which are parts of the profit. But the limitations, of course, the increase in the shareholders dilutes the owner, like reduces the ownership of the company, because you are selling parts of your control and ownership. Producing prospects to offer the shares for sale is expensive, because it costs a lot of money. Okay, so that's all. So for in the exam, you have to think about how the business is doing and the amount of borrowing they have, and so that you can decide for them which source of finance will be better for them, depending on debt financing or equity financing. That's the last part for the external sources of finance, and I will stop here, and we'll see you soon. Thank you. Goodbye.